Good afternoon. My name is Fred Judd. Today we're going to be talking about the individual income tax formula. When we're done, I hope that you'll understand what the components of the individual income tax formula are. The tax formula, said briefly, is the income that the United States will tax based on your own individual income and expenses based on the application of tax law to your individual situation. Let's talk about this a little bit. Here's the form that all of us use to file our own individual income tax return with the government. You'll notice that the first section here, called income, includes all types of income. We'll talk about that later. Then you see the words adjusted gross income. Actually, what these are deductions from the income that are used to then become your adjusted gross income. That becomes much more important. Then after that, you take your adjusted gross income and you determine what deductions you have that are typical deductions such as mortgage interest and other things. We'll talk about that a little bit. And then you come up with your taxable income. At that point, you take the tax rates that Congress has set and then apply that to your taxable income. Very good. So let's get started on looking at what the components of the individual income tax formula are. The first component of the individual income tax formula is to compute what our income is. The income is comprised of all the types of different income that many of us would receive, not just wages and salaries, but also dividends and interest, alimony if you're divorced and you receive it, business and farm income, capital gains, retirement pay, partnerships, even unemployment compensation, and other types of income that different people receive. Once you compute all of your total income, you then compute are allowed deductions for adjusted gross income. Those are items that Congress has decided to allow in the computation of our adjusted gross income. Things like payments to HSAs or health savings accounts, individual retirement accounts, the amount of alimony that is paid, moving costs or student loan interest, other things that many people that many people spend. And those are items that Congress has given an exclusion from adjusted gross income. Once you compute the adjusted gross income, that's a very number because that number is used to compute the percentage of deductibility of many other items on your return. Once you do that, you then take the deductions and find the deductions from adjusted gross income that many of us are more familiar with. For example, a standard deduction or the specific deductions that are on our Schedule A, for example, charitable expenses and state income taxes, to name a few. After you have computed the deductions, you also are given by Congress a personal exemption. That may be some amount this year in the $3,900 or $4,000 range for each one of your dependents on your tax return. So once you have taken your income, subtracted the deductions for adjusted gross income, then subtracted deductions from adjusted gross income, you have taxable income. And based on that, you then apply the tax rates that Congress has set, take tax credits that Congress has allowed, and you pay additional taxes such as self-employment tax or other specialized taxes. And with that, you have your net total tax, which is your fair or unfair share of taxes that we all have to pay. That concludes this mini lesson. I appreciate you taking the time to be with me today. Thank you. And if you have any questions, please email them to me. Thank you.